There were big falls in Europe last night for three reasons. As I mentioned last night, the Spanish bond yield is rising again as investors head for the exits, doing a Spanish flea, as it were. There's a political crisis in the Netherlands, and it looks like a socialist is going to win the presidential election in France. Now, as you can see, the fall on the French exchange last night was not the largest, but I have to show you the chart of the Paris share index this year, just so I can use that heading. The French correction is 14% since March the 16th. Other global markets fell less than 1% last night, so it was by no means a global rout. And there were fairly hefty falls on the commodity markets. Base and precious metals were sold off, although the oil price was steady. And the All Ordinaries closed virtually flat today, with the resources sector down, banks and Telstra up. And with confirmation with the CPI that rates are certain to be cut next week, the Australian dollar fell to 102 3/4 US cents. Now, a couple of charts on inflation. This one shows that apart from the fruit prices falling 30%, which they did, the low CPI is all about tradable goods, that is imports, which is in turn all about the currency. That brought down prices of TVs and computers by 6% in the quarter and international plane tickets by 4.8%. And the disappearance of inflation, or just about the disappearance, has helped bring the Australian 10-year bond rate down to a 61-year low of 3.67%. This is the interest rate that the government pays on its debt, and it's driven by a combination of inflation expectations and the perception of risk. In Australia these days, there's not much of either. And that's finance.